Well, basically, you've got two means by which you can purchase and sell things. One is final settlement, and final settlement is always payment in physical gold or silver. That goes back to Roman law, which started with the 12 tables going back 448 BC. And various jurors ruled on this and how credit works and all the rest of it relative to gold or silver or metallic money, if you like. It was all incorporated in Justinian's Pandects. And that is the basis of everyone's common law, because coming out of the Roman Empire, both East and West, were all the nations that have colonized the world. And separately, China has arrived at the same sort of conclusions over the millennia that we have. So that's money. Now, the rest of it is credit. Credit is not final settlement. Credit is an obligation to settle.
The current global economy is confronted with a tempest that is significantly more severe than the one that occurred in 1929. According to analyst Alasdair Macleod, the accident was particularly severe at that time. The dollar maintained some credibility, as it was still exchangeable for gold, despite the fact that Wall Street lost 90% of its value. This time, he contends that the situation is significantly more precarious. The strain will not be borne by equities alone, but by the very currency system itself, due to an unprecedented credit bubble, profoundly interconnected supply chains, and governments addicted to intervention. The modern fiat system is unbacked, which renders currencies susceptible to collapse due to the weight of excessive debt and failed policy responses. In contrast to the 1930s, when money was still anchored in a tangible form, Macleod underscores that the situation has been further exacerbated by the recurrent government interventions. Through artificially low interest rates, relentless balance sheet expansion, and a propensity to cover up every crisis with additional liquidity, central banks have attempted to obscure the underlying imbalances. However, the historical record indicates that such actions impede recovery rather than facilitate it. The early 1920s rapid recovery was a direct result of governments enabling markets to adjust naturally. Conversely, the 1930s heavy-handed responses extended the decline into a decade-long stagnation. Rather than addressing and resolving the system's flaws, contemporary policymakers are attempting to suppress them on an even larger scale, thereby perpetuating the same errors. They have established a financial structure that is significantly more fragile by refusing to permit corrections. This structure is susceptible to not only market downturns, but also the erosion of trust in the currency. He also contends that, despite the fact that Western currencies are threatened by debt and overvaluation, countries such as China and Russia have discreetly prepared themselves for resilience by accumulating substantial gold reserves. They maintain a strategic advantage that could one day support a gold-backed monetary system by embedding gold outside of official reserves and distributing holdings across sovereign wealth funds and institutions. This approach offers the potential to re-anchor their currencies to gold, a measure that could simultaneously realign the global balance of financial power toward the East and protect their economies from the collapse of fiat systems. We are now presenting the excerpts from Alasdair's interview. Please subscribe to our channel and activate the chime icon to receive timely updates before we proceed with our discussion. I appreciate your assistance and hope you enjoy the video.
Why you should now be actually preserving wealth rather than trying to accumulate wealth, because the whole system is looking very, very terminal. So that's basically, I started, if you like, at the beginning of, well, just before the end of the Bretton Woods system. And here we are, I think, at the end of the fiat currency system. So this should make for an interesting podcast. Worse than that, it misleads people. I mean, you know, the idea that people actually know about money has always been completely wrong. They don't. Very few people really understand it. Even economists. I mean, I've been involved with a debate with Austrian economists about the creation of credit. They don't understand credit, which I know sounds bizarre because their USP is they understand these things. Well, they don't. There's a big hurdle to overcome in terms of educating people about money and credit. So, I mean, the answer to your question is that I think everybody's being misled, and they're being misled by people who are meant to be experts who don't understand it. So, yeah, it's quite a thing to do. Well, basically, you've got two means of by which you can purchase and sell things. One is final settlement, and final settlement is always payment in physical gold or silver. That goes back to Roman law, which started in with the 12 tables going back 448 BC. And various jurors ruled on this and how credit works and all the rest of it relative to gold or silver or metallic money, if you like. It was all incorporated in Justinian's Pandects. And that is the basis of everyone's common law, because coming out of the Roman Empire, both East and West, were all the nations that have colonized the world. And separately, China has arrived at the same sort of conclusions over the millennia that we have. So that's money. Now, the rest of it is credit. Credit is not final settlement. Credit is an obligation to settle. And that obligation to settle is always in final settlement, what they call corporeal money, which is physical money with no counterparty risk. There was basis, if you like, of gold standards, and I think the best system that evolved over the millennia was really the UK in the 19th century, when the sovereign came into being, and we went on to the pound went on to a gold standard, fully exchangeable. You could exchange the Bank of England's pounds into sovereigns. Between about 1822 and the outbreak of the First World War.
There was no inflation.
There was no inflation, yeah. And this is the other thing. I mean, understanding how credit creates inflation is another thing. Because if credit is deployed in the form of, let's say, capital to increase production, it's not inflationary. If, however, it is deployed to increase consumption, in lieu of savings, then it is inflationary. And if it is deployed to puff up asset prices, which actually is what's going on today, then that inflates asset prices. So, but for every credit, there is a debt on the other side. Now, we all recognize there's a debt bubble, but do we recognize we're in a credit bubble? I think very few of the people punting in, the momentum stocks in the market actually understand that it is a credit bubble. And, you've got to point out to them, debt is the other side of credit. You can see the debt. It's obvious. This is the biggest debt cum credit bubble in history by miles, far bigger than 1928 to 29, roaring 20s, and what happened subsequently. This is far, far bigger.
The global financial system is currently facing what is widely regarded as the most significant credit bubble in history, one that surpasses the imbalances of the late 1920s. The structure has become so fragile that central banks are unable to permit deflation without risking a systemic collapse as a result of decades of unregulated debt expansion and artificially low interest rates. In order to mitigate this, policymakers have increasingly implemented aggressive monetary intervention, which involves the issuance of new reserves, the expansion of balance sheets, and the inundation of markets with liquidity. Although these measures temporarily postpone the collapse, they also erode confidence in fiat currencies, as the relentless production of money begins to undermine their credibility. The current stability that is apparent is actually a slow-burning crisis that poses a threat to the very foundation of the global financial order. Macleod emphasizes that the fundamental issue is structural. Credit has been the lubricant of modern economies for a long time. However, its excessive use to finance consumption, inflate asset prices, and cover government deficits has transformed it into a destabilizing force. In contrast to productive credit, which underpins development, the current abundance of unproductive debt has resulted in fragility on both public and private balance sheets. The outcome is an economy that appears to be functioning on the surface, but is already in a concealed decline when government deficits are excluded from GDP figures. In this context, gold is not merely increasing. It is revealing the vulnerability of paper currencies. A prolonged bear market in fiat money is more accurately described as what many interpret as a bull market in metals, suggesting that the denouement for the current system may be closer than policymakers realize.
Yeah, I think what you're referring to is credit substitution. There is no doubt that as the credit bubble pops, then financial asset values are going to go down. You will find also the risk of holding credit rises, which basically means that interest rates or bond yields along the yield curve will rise. And under those circumstances, the central banks tasked with being the lenders of last resort will try and replace contracting private sector credit, commercial bank credit, etc., with fresh currency both in the form of notes and also reserves on its balance sheet. So, you're right. And it's that will collapse the currencies because we cannot afford, if you like, to allow our economies to go into what they call recession. We used to call it a slump. We're already doing that, incidentally. If you take government deficits out of GDP, remove that from GDP, and over the last 2 or 3 years, you can see that we're already in a slump. And you go up and down the country, go into the high streets, see what's going on there, go and talk to people, see what's going on with them. And things are extremely difficult. But, this doesn't show in government statistics as much as it should. So we're already got the conditions, if you like, that are creating this existential crisis, the end of the fiat currency system.
And presumably it's gold that's primarily signaling there's a fire raging.
Yes. I mean, the way to look at it actually is not gold is in a bull market. Gold is
all currencies are in a bear market. But
all currencies in a bear market. Currencies are going down. I mean, the way you've got to look at it is you're not buying gold, you're getting the hell out of credit. Because currencies are credit. And incidentally, modern economists don't actually recognize that currencies are credit. They're not well versed in the difference between money and credit. And to ask, the first attempt by the Romans to bring in law, if you like, to regulate how people behave with each other and with the authorities of the day, were the 12 tables. Or you could interpret it as the 12 tablets, which, of course, was really what tables meant in that sense. And this governed all sorts of things, the relationship between, the leader of a house and women and the slaves and all the rest of it. Now, a lot of this doesn't apply today. A lot of this we've evolved away. But they did determine what final settlement was. And we're talking about it at a time when very few people could read or write. So there were all sorts of procedures to ensure that you had final settlement, and also to establish what wealth individuals had, and possession and property rights and all the rest of it. It all stemmed from that. At the same time, they produced the first Roman coin, which was called the ice, spelled AES. And the ice was about 1 pound of bronze. Gold and silver came in later, in fact. But we evolved into a situation where gold and silver became the preferred higher value coins. And that, of course, persisted the whole way through. And it persisted all the way through to relatively recently. I mean, we got sovereigns. We had coins made out of silver and coins made out of copper, which was the third element. I mean, if you like, copper was the pure form of bronze, or the dominant form of bronze, which the ice was made out of. So that was the origin of it. And over the next 1,000 years, basically from about 450 BC all the way up to the 6th century, when Justinian's Pandects came out, you had Roman jurors ruling on things like settlement. I mean, all sorts of aspects of Rome, just developing, if you like, from the 12 tables, all these, sort of considerations, what was criminal law, civil law, all this sort of stuff really came out from these jurors. The principal jurors who determined the role of credit in an economy and how it should be treated were a juror called Alpian and a juror called Paulus. And Alpian and Paulus lived in around about the 1st and 2nd centuries AD. Or more likely the end of the 2nd century AD. So we're looking at around about 200 AD. So these guys, and particularly Alpian and Paulus, as opposed to Gaius, who was another one who made all sorts of rulings, they determined that you could transfer a debt without having to get the agreement of the debtor. Now, this is terribly important because if you can buy and sell debts, then you've got the basis for value and basically of wealth.
The implications for gold and silver would be profound if the current trajectory of excessive monetary intervention and increasing debt burdens persists unabated. These metals would be increasingly perceived as fundamental pillars of financial stability, rather than merely as hedges as trust in paper currencies erodes. Gold, which has been long considered the anchor of value, may experience unprecedented demand from both institutional purchasers and sovereign states that are attempting to protect themselves from fiat risk. Silver, which serves as both a monetary and industrial metal, is expected to experience even greater gains as supply constraints and a surge in strategic demand intersect. This scenario would result in a significant resetting of the conventional relationship between metals and currencies. Prices would no longer be primarily determined by speculative flows or short-term market sentiment, but rather by the structural reallocation of wealth from depreciating currencies to tangible assets. Gold and silver could be elevated significantly above their historical benchmarks through a sustained repricing, thereby transforming them from defensive assets to the bedrock of a new financial system. In your opinion, what is likely to transpire next? Will the price of these commodities increase, or will they disrupt the entire financial system and prompt us to reconsider the true nature of money? Please express your opinions in the comments section below. If you find this video to be informative, please consider supporting us and activating notifications to remain informed about our most recent videos. I will see you in the subsequent video. I appreciate your attention.